What's going on, everybody? This is part 3 of the 3-part series we have on everything that affects an option contract's price. So we're going to talk about implied volatility and how it can really drastically affect the value of an option contract. So implied volatility is the measure of a market's expectations for future volatility. What do I mean by that? Well, if you look at the chart, this is an example that we've been using in Walmart, right? Implied volatility is a number given to a stock that shows the deviation, basically the direction that the stock tends to move between. So we talk about support and resistance lines a lot. When you see a stock moving in a tight little channel like this, in this case like a $5 move on a $140 stock, it's going to have a lot less volatility than a stock that's moving aggressively in one move. So I think a good one to use would be LUMN. I saw that one earlier. So as you see, LUMN has been going down and down and down and down, not really finding direction. Back here it had a good direction, but as you can see, it's going straight down. So it's been moving from $12 all the way down to $3. So this would have a high implied volatility because the price has dropped drastically over the past few months. Whereas we go to Walmart, back to Walmart, WMT, there we go. And see on Walmart, it has actually moved pretty tight right through here. And it has shown you that it's really only fluctuated between $140 and $145. So this will give it actually a lower volatility because it's a lot more predictable on where the price is going to be. That right there just gave you the answer to how you use this. Predictability. All right. So what do I mean by that? If we go to TastyWorks, let's see where we at here. Boop, boop. All right. So I got my Walmart example here, right? And you see this little number right here? This is actually the IV rank. What that means is it's a number between 0 and 100 given to different stocks by TastyWorks to determine their implied volatility level. Their rank is a 7, which means 7% implied volatility. So if it's closer to 0, that means it's low. If it's higher to 100, that means it's high. 50 is your middle ground, which kind of gives you a little bit indecisive area. So anytime you see a low IV rank, you can be a little more, not necessarily reckless, but you can have a little more risk and actually do something we call buying calls. Or actually, if you go to our spreads here, we talked about spreads in the past, this would be a play where you actually may want to consider buying a call spread because it has such a low IV rank. If you catch it at the bottom on that support line that we've had in other videos, it shows you how to draw support lines, you can actually have a higher predictability that it's going to go up in value versus going all over the place. This means that you're not really going to worry much about that time decay, and you really get to capitalize on the delta and see the increase in the value of the stock. Now, on the inverse of that, let's go back to LUMN. So LUMN would be a little bit different. You would actually want to do the opposite. This is above 50 right here. You'd want to consider short puts if you're bullish. So what I mean is if you do short puts, you'll have an IV rank of 80. That means that you have no idea where this is going. So if it pulls back on you some or rallies up like crazy, you'll have a higher probability of profiting because you have a put spread out. And that way you at least get to capitalize on the theta because the delta won't affect you as badly as it would on an actual call spread. So if we went to a call spread, let's see right here. Yeah, so we went to a call spread and set it up right here. The delta would affect you a little more aggressively, and you'd also have theta working against you. And mainly it's like this, guys. The reason that the implied volatility is pretty bad to do a long call, this thing could plummet and go to 2, or it could ricochet and go to 8. It's a gamble. We don't gamble when we trade options. We give ourselves a trading edge. So what we'll do is we'll go in, we'll find good setups using our technical analysis. We'll also use TradeUI. Click that link description below. Take you right to TradeUI. You can check out the trial. Make sure it's for you. You can utilize all the tools they have like option flow, the aggressive buyer index, the insider trading. Everything there's given in there for you. All you have to do is find your setups and execute on the setups. The whole reason we went through this whole series is to show you the importance of theta, delta, and implied volatility. And this is probably the most important lesson here. If you see an IV rank of 50 or higher, you want to sell puts. If you see an IV rank of 50 or lower, you want to buy calls. If you can understand that, if you're a bullish trader, you will have higher success. You'll have higher success, more wins, and higher returns than you would have before watching all 3 of these videos. Guys, I really hope this content was helpful. If you have any questions, put in the comments below. If you like this stuff, give it a like. Go ahead and subscribe. Check out the other videos we have, guys. It really helps promote the channel, and all we want to do is make everybody better traders. We're going to end it here, guys. I hope y'all have a great night.